What is going on with these tariffs? That's a question I've been getting quite a bit the last couple of weeks. So I just wanted to jump in here and record a quick episode on exactly kind of what I'm telling clients. I posted a LinkedIn post of this too, but kind of just sat down after getting some client concerns about a week ago and thought about how does this make sense in the global context of economics, and how does this make sense in how we should view markets and our investments and financial planning. So just wanted to go through quickly kind of the email that I sent out to my whole list, all my clients, basically summing up my thoughts on the situation, how to frame our thinking about this. So this is kind of divided up into 5 points. So that first point for me, let's just think about like markets corrected very, very quickly. So a correction means 10% or more decline from an all-time high. So that happened a week, maybe 2 weeks ago. How common is that? That's kind of scary to watch your portfolio go down 10%. The answer to that question is extremely common. They actually happen every year or so on average over the last 7,500 years. The average rebound from that decline of 10% or more is about 4 months. So they happen all the time. The rebound from that takes about 4 months. So thinking about that, a 10 to 15% decline in S&P 500 or however you want to measure the market or your portfolio shouldn't be all that concerning to us. I think that these corrections are so common. I almost describe them as healthy. Markets cannot go up 25% a year, right? In 2023 and 2024 here in the United States, generally stock markets went up 20 to 25%, depending on what index you're using to measure. That is not healthy. That cannot happen year after year after year. So correction, although it's not fun to watch, actually very, very healthy. So this infographic I'm looking at right now, a couple other stats from that market corrections, 15% or more decline happens 1 every 3.5 years. And a 20% or more decline happens about once every 6 years. So this was S&P 500 data from 1948 to 2017. You know, the numbers may vary if you widen that range or shrink that range. So market declines, they kind of happen all the time, to be honest. What should we expect after a 10 or 20% decline? And has there ever been a permanent depression of stocks? So now that we kind of understand that markets have declined, our second point is, what should we expect next? Like what happens on average? And then I think the second question, which is a little bit, I'm kind of serious, but not serious about it. This idea that you could ever permanently lose money in the stock market. Let's take a look. This is another infographic that I'll read out to you from July 1926 to December 2023 in the FAMA French Total U.S. Market Index. They measured what happens after a 10, 20, and 30% decline. What are those returns after those declines? After a 10% decline, which we've had, we haven't quite hit 20 yet. Depending on what market you're looking at, maybe you've hit 20, but I'll just read out the 10. After a 10% decline, we've had 1-year returns of 11.8% on average, 3-year returns of 34.6% on average, and 5-year returns of 68.7% on average. Those are pretty astonishing numbers. You think when markets go down, getting out would be the best thing? This is telling you the exact opposite. Let's look at a 20% market decline. So the 1, 3, and 5-year returns are going to be 21%, 42.5%, and 74.9% after that 20% market decline. After a 30% market decline, right? And that's a little bit more rare. It's only happened a few times. Great Depression, think about stuff like that. Those 1, 3, and 5-year returns are going to be 23.9%, 24.5%, and 50.1%. So it's not a matter of if, but simply when stocks will rebound. The idea of a permanent loss in equities or the stock market is pure nonsense. Honestly, that's the nicest way I can put it. It's been that way for the last 100 years and always will be. I'm not promising the next 2 months, 3 months, the next year, the next 3 years. I don't know what comes around the corner. All I can do is look at the data. It's telling me being a long-term investor is a prudent thing to be doing. And I can look at what's happening right now in the markets in the world. And I can realize that a lot of this stuff is temporary. And for stocks to be down permanently, like to lose money, I think that's what people get scared about. Oh, I lost money. Well, if you didn't sell out of your portfolio, you actually didn't lose money. So we should expect pretty good things after market declines. Again, the last 100 years is telling us the same story, decade after decade after decade. There's another piece of data here that's relevant. another graphic from the S&P 500, all the bear markets back to 1950. So a bear market is 20%, as a 20% decline or more. All the bear markets back to 1950, they measure their returns 1, 5, and 10 years later after those bear markets. I can't read out every single bear market, but I can tell you that the only negative number, 1, 5, and 10 years after all of these bear markets, the only singular negative number on this graphic is 1 year after the tech bubble burst in the early 2000s. 1 year after, markets were down 12.5%. Most of the numbers on here are astonishingly positive, right? So if we look at like the 2009 real estate bubble, 68% from the bottom, that was the return. 1 year later, 5 years later was 177%. 10 years later was 305%. Kind of telling us the same story. No such thing as a permanent loss in equities. Okay, number 3, okay, it's scary. We understand markets are going to go down. They're going to go back up maybe. But wouldn't it be smart if we could just jump out of the market for this downturn? The data tells us we just cannot do this reliably. I'm recording this on April 14th, 2025. Last week, we had a stock market day. I forget, I think it was Wednesday, if my memory serves me correct, the 8th. Don't quote me on that, but somewhere in that range. We had a day where President Trump came out and said he's going to pause tariffs for 90 days. The market surged around 9% that day. If you were out of the market that day, it's not crazy to think that that's a 7-figure mistake. If you're in your 30s, 40s, 50s, and we have substantial dollars at stake here, and we missed a 10% day in the stock market, it is not crazy to say that that was a 7-figure mistake. That's not exaggerating. The graphic I'm reading right now, I'm looking at, is the Russell 3000 index from 2000 to 2024, so a 24-year period. If the growth of $1,000 invested in that grows to 6,600 if you just keep it in there. If you miss that best week though, you're really scared around one of these times where markets kind of surge back after tariffs or whatever it may be, that 6,600 drops to 5,500. So over 10% loss there. If you miss the best month, it's 52.74. You miss the best 3 months, it's 46.55. You miss the best 6 months, it's 42.86. So we can see that 6,600 dwindle substantially. We can lose 25% of that just by missing the best periods in those 24 years. So again, some of the best periods we should realistically expect to come after some of the worst days. So we have bad days in the market. They're really scary. They're really hard to watch. We should actually expect really good days at some point after those bad days. And we cannot miss those good days. You cannot afford to miss those good days. It is detrimental to your future wealth. Okay, point number 4 I want to make. We'll get away from data a little bit, just into theory. Policy is written in pencil and it's temporary. It's funny, I wrote this email to my clients, one of my clients that sent a specific request or specific concern. I wrote this back to her. I then sent this whole email out to all my clients. And by the time this went out, it's funny, the day before this went out, President Trump did come out and say, hey, we're going to pause tariffs for 90 days on everyone except China or something. But my point being here, so you proved my point right. My point is, this is a policy that's temporary. It's written in pencil. It is not the 2008 real estate downturn. It is not COVID that would shock the market and still is shocking housing markets today. It's something that can certainly affect the economy, certainly affect supply chains, businesses. I'm not downplaying that, but I am downplaying the permanence of these policies. These have come out in a matter of weeks or days. They could be rescinded in a matter of weeks or days. And we've seen that happen just in the last week. On a broader scale, if we zoom out a little bit, government administrations and policies, they come and go. Tax law, it's written in pencil. Who's in power? Who's got the Supreme Court, Congress, Senate, House, executive branch, executive orders. These things come and go. How many Republican and Democrat presidents have we had the last 80 years? They kind of flip-flop. We've had periods of Republican, periods of Democrats. We've got a Republican majority right now in all 3 branches. That could persist for 2 more years, 4 more years, 8 more years. At some point, that will probably change. History just tells us that. So I guess my point is here, if we're long-term investors, we're investing for decades, and that's true whether we're 30 or 65, you're still investing for decades. And typically those that are 65 even are investing for longer than that, longer than their lifetime, because a lot of that money sometimes is going to their heirs. But for us long-term investors, which should be all of us, we have to take this with a grain of salt, the emergency of the day, all this news, all this bad press. We got to just say to ourselves, this too shall pass. So policy is very, very temporary. Okay. Number 5, my final point, businesses will adapt and change to produce profits in any new environment. They've done it for decades, right? And they're going to continue to do it for decades to come. If we're investing in a global portfolio of US international companies, the best in the world, that is saying we are raising our hand and saying, I believe in the best and brightest minds in the entire world and their ability to create goods and services and generate profits and value for their shareholders. If that's not true, if you don't believe in global development and global economics and the best minds in the world creating profit and value for the people of the world, then I guess investing isn't for you. But for those of us that think that's probably happened over the last hundreds of years and will probably continue to happen, owning global equities is a very, very good decision. So if we compare this, just to wrap things up, to historical events like COVID, the real estate crash of 2008, World War I, World War II, and we look back at how markets have performed after those events, it kind of makes this recent tariff and policy hiccup look like just a minor speed bump in the scheme of things. So that's all I have to say today. I hope that was helpful. So just to wrap up, other than staying put, investing globally, believing in our long-term plan, all of those good things that I've talked about, there are a few helpful things we can do during this time. 1, if you hold excess cash, invest that excess cash. Probably a very good time. I'm not a fan of market timing, as anyone who listens to this podcast will know. But if you happen to hold excess cash for whatever reason during this time, putting that to work can be very, very beneficial in a market downturn when you play that out over many, many years. So that would be 1. Number 2, rebalance and harvest losses. So depending on your portfolio composition, maybe your holdings have gotten out of tolerance, kind of out of whack. If I hold 50% US and 50% international, maybe that's changed over the last couple of weeks. Just a time to take a look at that. Also, harvest losses. So that's when you sell a security in your taxable brokerage account at a loss and replace it with another security. You take a loss on paper, you're able to take that against your taxable income up to $3,000 per year and roll that forward to future years against capital gains. So something that I'm doing personally in my firm for clients right now, definitely rebalance and harvest losses. Number 3, Roth conversion. So if a Roth conversion makes sense for this year for you to convert money from pre-tax traditional IRA to Roth, it might make sense when the market goes down to do that earlier rather than later this year. So if the market goes down 15%, that means your Roth conversion is actually on sale 15%. You're paying tax on a 15% lower value. So something to look at and assess on a case-by-case basis. That's certainly what I'm doing with my clients. Okay, reassess and risk tolerance and your need for cash for short-term goals. That would be the very last one I would say. So some people think that they can invest in all stocks and they don't need any bonds or cash or whatever. It's really easy to be, all stocks and very bullish when the markets are going up 25% a year. However, when we see market downturns of 10, 15, 20%, some of the stuff we're seeing here in early 2025, that might be a time to reassess your risk tolerance. Do you have the stomach to hold that much money in the markets? Or is some of that money maybe supposed to be short-term money for a down payment on a house in the next year, 2 years? Maybe should some of that be in a high-yield savings account or short-term treasuries where we're getting a decent 4.5% yield? So during these times when markets do go down substantially and really quickly, just another really good time to reassess your risk tolerance for that specific bucket of money that you're looking at. Okay, I hope that this was super helpful. Let me know if you have any questions. If I could sum this up, 100 years of data shows us we should be eternally optimistic about the long-term future of the world. The global economy and the stock market can be kind of scary in the near term, but if we zoom out, focus on the long term, which we should always be doing, we can kind of see that this last month doesn't change anything in the slightest. So this time is not different. I hope this was helpful. Let me know if you have any questions, and we'll see you back in a couple weeks. Thanks. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the Bluff Finance Podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.